Okay, Assalamualaikum and very good morning everyone. Today, I will present the financial ratio analysis for Aeon Company Berhad and EcoShop Marketing Berhad based on their 2025 annual report. First, let me briefly introduce both company. Aeon Company Malaysia Berhad is one of the largest retail company in Malaysia and has been listed on Bursa Malaysia since 1989. It is a subsidiary of Aeon Company. Aeon operates department stores, supermarkets, shopping, malls, and pharmacy, and the digital retail platform through Malaysia. On the other hand, EcoShop Marketing Berhad is a fast-growing value retail company that offers affordable everyday household product. It is a business model focuses on high sales volume, efficient inventory management, and an integrated supply chain, allowing the company to expand rapidly across Malaysia. Although both companies operate in Malaysia retail industry, they are different in terms of pricing strategy, business scale, and capital structure.
I will presenting the financial ratio analysis of Aeon and EcoShop for the financial year ended 31st May 2025. The financial performance of both companies is evaluated using 4 categories of financial ratio: liquidity, profitability, efficiency, and leverage. Starting with liquidity, EcoShop records a current ratio of 1.80 compared to 0.63 for Aeon. Its quick ratio is also much higher at 0.91 while Aeon records 0.21. This result indicate that EcoShop is in a stronger position to meet its short-term obligation. For profitability, Aeon achieved a higher gross profit margin of 43.11%, showing better pricing power. However, EcoShop performs better in overall profitability with a net profit margin of 7.35% compared to 3.12% of Aeon. EcoShop also records significantly higher returns through both ROCE and ROA. In terms of efficiency, EcoShop has higher inventory turnover, fewer inventory days, and a shorter collection period, and a higher total asset turnover ratio. These figures suggest the EcoShop manages its inventory, receivables, and assets more efficiently than Aeon. Lastly, under leverage, EcoShop has a lower debt levels and a much higher interest coverage ratio. This indicates lower financial risk and a stronger ability to meet its debt obligation. Based on the financial ratio, EcoShop demonstrates stronger overall financial performance than Aeon. Looking at the liquidity, EcoShop is better able to meet its short-term liabilities because of its stronger current and quick ratio. In contrast, Aeon's lower liquidity ratio suggests that it depends more on inventory and continuous sales to support its daily operation. This is common among large retail chains, but it also reflects tighter working capital management. For profitability, although Aeon earns a high gross profit margin, EcoShop converts more of its sales into net profit. Its higher ROCE and ROA shows that the company uses its capital and assets much more effectively to generate returns for shareholders. In terms of efficiency, EcoShop sells inventory faster, collects receivables more quickly, and generates more sales from its assets. This reflects stronger operational efficiency and better resource management. Regarding leverage, EcoShop maintains a lower debt ratio and debt to equity ratio while achieving an interest coverage ratio of over 10 times. This means the company has lower financial risk and is in a stronger position to service its debt compared with Aeon. Overall, EcoShop outperforms Aeon in 12 out of the 13 financial ratio analysis. The only area where Aeon performs better is its gross profit margin, reflecting stronger pricing power and cost control. Overall, EcoShop demonstrates superior liquidity, profitability, efficiency, and financial stability.
Comparing both companies, Aeon's strengths is its scale and higher gross margin of 43.11%. Its weaknesses are lower liquidity, lower overall profitability, and higher financial risk from more debt. EcoShop's strength is the opposite. Best liquidity, highest profitability across NPM, ROCE, and ROA, and stronger financial stability with lower debt. Its weaknesses is smaller scale and lower gross margin. So in short, Aeon wins on size and margin, EcoShop wins on liquidity and financial health that lead us into our overall recommendation.
Now, I will summarize the overall financial performance of both companies from our analysis. EcoShop performed better than Aeon in 12 out of 13 financial ratios. EcoShop has a higher ROCE of 22.54%, which means it uses its capital more efficiently to generate profit. EcoShop also has a higher interest coverage ratio of 10.22 times, showing that it can pay its interest expenses more easily than Aeon. However, Aeon performed better in gross profit margin with 43.11%, meaning it earns more gross profit from its sales. Overall, EcoShop shows stronger financial performance, especially in profitability, efficiency, and financial stability, while Aeon remains a stable and well-established company. So the next one is the recommendation and the conclusion. For Aeon, we recommend improving its cash flow and liquidity, reducing inventory holding days, lowering its debt, and continuing digital transformation to improve efficiency. For EcoShop, we recommend maintaining its strong liquidity, improving its gross profit margin through better supplier negotiation, investing in inventory technology, and continuing its conservative financing strategy. In conclusion, our analysis shows that EcoShop has better overall financial performance than Aeon. EcoShop performs better in liquidity, profitability, efficiency, and financial stability. However, Aeon is still a strong company and can improve its performance by following this recommendation.